Hi, I'm Todd Rosenbluth, Head of Research at Vetify, and thanks for joining us for another episode of ETF 360. I'm here with Graham Day of Innovator ETFs, and we're here to talk about a new managed floor ETF. Graham, thanks for joining me.
Todd, it's great to see you as always.
It's my pleasure, Graham. 2022 has been a volatile year for equity ETFs. How can defined outcomes play a role in investor portfolios?
That's a great question, and really 2022 has been the year that our defined outcome ETFs have really shown their value. Not only have equities been falling, but you've also had fixed income falling in lockstep with equities. And so the question has to be asked by advisors is, how do I add protection to my portfolios? Historically, bonds have been that source of non-correlated asset to buffer the performance of equities. That has not held up in 2022. But what has held up is the buffer ETF structure. And so again, these ETFs provide equity upside to a cap, and in exchange for that cap have known levels of built-in protection of 9, 15, or 30% over a one-year outcome period. And I think why they've been so successful is because as the equity markets have fallen, the buffers have done exactly what they were supposed to do. And with the heightened volatility, advisors want to know what they can expect. And the defined outcome ETFs are unique in providing advisors the ability to know their outcome potentials all before investing. And with volatility extending across asset classes, again, we think that that's incredibly valuable today.
So you mentioned advisors. How have they been using the ETFs, the defined outcome ETFs in particular, and from an equity perspective, a fixed income perspective, a combination?
That, Todd, we've seen it evolve over time. Back in November of 2020, we were talking to advisors about, look, interest rates are at zero. How much lower can they go? It really seemed at that point that the risk was to the downside with bonds. Many advisors that we were talking with had underweighted their fixed income position because they just saw the writing on the wall. There wasn't a lot of reason to be invested in fixed income at that point. And so we saw our buffer ETFs utilized as somewhat of a bond replacement. Now, the buffer ETFs don't provide income, but they give you somewhat of a hybrid characteristic between equities and fixed income. And so we saw the buffer ETFs being utilized for those positions that maybe an advisor underweighted their fixed income allocation, sliding a buffer ETF as a replacement. Now, with interest rates rising, with volatility rising, we've seen the upside potential on our ETFs rise significantly. For example, a product that has a 15% buffer on the S&P 500 over 1 year, the cap on that product has gone from 9% a year ago to over 20% today. And with caps over 20% with a 15 buffer, we're seeing advisors saying, you know what, now there's increased uncertainty in the equity market, and a 20% cap that can still work in my equity allocation. And so now we've started to see advisors using it as a portion of their equity portfolios as well. So really, the characteristics of the ETFs have caused advisors to change how they're using. But again, the known upside, the known downside has been incredibly valuable, whether you've used it as on the fixed income side or on the equity side.
Well, that's great. But let's talk about the new product that came to market, a managed floor ETF. Tell us about it and how it's different from the rest of your lineup.
Well, Todd, I'll say we're very excited about this product. Obviously, we're forging Innovator into the risk management arena. That's what we've been known for. And one of the things that we've always tried to solve for is how can we build a product that seeks to cap losses. If we think about the buffer ETFs, those hedge against initial market losses. But we've always had advisors asking, is there a way to protect or cap my losses? And really, what Parametric brings to the table is the ability to build an equity-based strategy that targets a 10% max loss. It ladders in 10% puts and funds those by selling these short-dated calls. Now, what does that do? It gives investors the upside to the equity markets with those laddered 10% floors, and then Parametric is systematically selling these short-dated calls to cover the cost of those downside puts. And what you get is a strategy that has been able to keep pace in big up years, but also help to cap those losses in the big down years. And so we really view it as filling a need in the Innovator lineup, something that can serve as both a tail risk hedge strategy, but also as a core equity strategy, given the upside potential. So we're really excited to be partnering with Parametric, tapping into their expertise. They've been known for risk management strategies for many years, and now we get to help take that expertise and place it into the ETF wrapper.
Well, that's really exciting, Graham. Congratulations on the new product and all the success at Innovator. And thank you, everyone, for joining us for the ETF 360. We'll see you next time.